Business law. We are covering chapter 8. Almost half of the chapter we have covered so far. So let's move forward. There's a topic called capital maintenance. Capital maintenance. Company need to maintain their capital. Company need to maintain their capital. Why company need to maintain their capital? To satisfy the lenders, to satisfy the debt holders. Because if company is having enough capital, lenders, debt holder feel secure. Like in case of any issue with the company, will be able to recover our money. So what's the purpose of maintaining a capital? The share capital of our limited company is regarded as a buffer fund, additional fund for creditors. Because if company is having more capital, mean more equity than debt, they feel secure. Because if company is having more debt, less equity, company is more risky. Even a debt holder, creditors don't feel secure. Because if company is going to wind up, they will not be able to recover their money fully. Capital reserve, then what about capital mean equity. Equity means share capital plus reserve. Note that the creditors buffer is accounting fund, not real money. The actual cash or assets subscribed can be used by the company. Obviously, capital mean where the capital is invested into the asset of the company. The rule on maintenance of capital exists in order to prevent a company reducing its capital by returning it to its members. That's why company never ever pay back money to the shareholder. If shareholder need their money back, they cannot ask the company keep their shares and give us our money back. No, they need to sell shares in the market. So company capital will remain same. Whether directly or indirectly, this means that as a general rule, a limited company cannot reduce its share capital. There is, however, an exception to this general rule, which is discussed below. But there are some exceptions. Reduction of capital. Under Companies Act 2006, a company can reduce its capital at any time for any reason. I mean, they can give their shareholder money back to them in case of three ways, three circumstances. Number one, reduce or cancel liability on partially paid shares. The company give up any claim for money owing. In share definition, it is a interest of shareholder. First, it create a liability. How it create a liability? In case of any unpaid share capital. If shareholder is having any liability, mean unpaid share capital, company can offer them, okay, don't pay this amount, and through this company can reduce share capital. Like share repurchase, like a share repurchase. No, sale or repurchase is something else. That is relating to asset. Capital maintenance means company need to maintain its share capital. Company will never ever reduce it. But company can reduce share capital in three ways. Number one, when there is any unpaid share capital, so company can, if company don't need further money, company have managed their requirement according to paid up share capital. So company can ask the shareholder, please do not pay the remaining amount. We are going to reduce your shares with whatever amount you have paid. In that case, company can reduce share capital. Second, return capital in excess of the company need. Company issued shares for $100,000, but Why company should shares? Company was in need of money. Might be company need to invest somewhere. And while making investment, company total required investment was 50,000. So company have generated 100,000. There is no other opportunity for the remaining 50,000. So instead of keeping that 50,000 excess cash, what company will do? They will return back to the shareholder, and through this company can reduce share capital. So share capital company need to maintain, company do not reduce. But there are three exceptions where company can reduce. In case of unpaid share capital, company can allow the shareholder do not pay the remaining amount. We are going to adjust your existing amount with lesser number of shares. In case companies are having a excess amount in case of new share issue, so company can pay back to the shareholder excess amount if company do not need it. And thirdly, cancel the paid up capital that is no longer represented by the assets. If the company has a debit balance on reserve, it can write this off by reducing a capital and thereby does not need to make good past losses. Thirdly, company can reduce share capital while adjusting with the past losses, mean in case of negative retained earnings. So there are three ways in which company can reduce share capital. Number one, in case of partially paid shares, company can reduce the liability of shareholders. Secondly, if company is having excess money generated in case of new share issued, company can return back some of the money to the shareholder. And thirdly, cancel the paid up share capital that is no longer represented by the assets. What does that mean? In case of losses, company can adjust losses with assets, mean share capital. What's the procedure company need to follow for reducing share capital? First, company need to pass special resolution, means 75% majority shareholder voting. Apply to the court to confirm the special resolution. If reduction involves one of the first two methods above, mean these two methods, if reduction is due to these two methods, court must require company to settle a list of creditors entitled to object. There is no objection from the creditor to reduce share capital. Why company need to maintain share capital? To keep creditors happy. They want share capital should be maintained. But if companies are going to reduce in these two cases, they need to put no objection certificate from creditors to the court as well. The court must not confirm the reduction until it is satisfied that all creditors have either consented, mean provided their consent through no objection certificate to the reduction on had their debts discharged or secured. Mean companies having asset against the debt holder liabilities, or debt holders have provided their consent, mean no objection certificate. In that case, court will allow the company to reduce share capital. The company must file document with the registrar. In case of reducing capital, company need to inform the registrar. If the share capital of a public company fall below 50,000, ultimately it will become private company. It must re-register as a private company. In case of reducing share capital, company need to pass special resolution. Should be approved from the court. In court, company need to submit no objection certificate from creditors, as well as company need to inform the registrar within 15 days. And if share capital is going to reduce below 50,000, then company need to re-register itself as a private company. Because for public company, your share capital must be above 50,000. Simplified procedure for private companies. If private companies are going to reduce their share capital, what is the procedure? Pass a special resolution supported by solvency statement. What is solvency statement? Solvency statement mean they need to show how their asset is covering their liabilities. The solvency statement is a statement by each of the director that the company will be able to meet its debt within the following year. Following year mean next at least 12 months. Mean company will be able to meet its debt in next 12 months, mean companies having asset equal to liabilities. A solvency statement made without reasonable ground, if assets are not equal to liabilities without reasonable ground, is an offense punished by fine and imprisonment. I mean, if in they are preparing false accounts, I mean, actually their asset worth is not equal to liabilities and they have overstated their asset just to show they are equal to liabilities. So this is a false. In case the directors, mean the persons who are preparing solvency statement, they will be fined or put into imprisonment. Copies of the resolution, solvency statement, and statement of capital must be filed with the registrar within 15 days. Cash understanding 4. Special resolution is required. Passing a special resolution and obtaining a court's permission as well. Go public limited company. Treasury shares. What is meant by treasury shares? Sometimes companies buy their own shares. Sometimes company buy their own shares to maintain capital. From where? From reserve. To maintain capital, sometimes company buy their own shares. From where? From reserve. Share capital increase. From where? Share premium. Or reserve. What is share premium? Reserve. So this company can show more capital. Why? Keep the creditor satisfied. This is called treasury shares. But after some time, what company do? They cancel it. If liabilities are reduced a little bit, so they will cancel it. These are created when a company purchases its own shares from distributable profit, but not from premium, from retained earnings. The shares do not have to be cancelled. Up to 10% of the shares can be held in treasury, which means they can be reissued without the usual formalities. But how much company can buy its own shares? Up to 10%, not more than this. Previously, treasury shares could only be created by public companies, but since 30th April 2013, they can be created by private companies as well. General rules. Shares which are purchased by a company must be cancelled and the amount of the company share capital account reduced by the nominal value of the cancelled shares. But there are some exceptions. Under Companies Act 2006, company can buy, hold and resell their shares. The share must be purchased from distributable profit and the company can cancel or sell them at any time. Under Companies Act 2006, the share will be give the company any voting rights, not give any voting rights in respect of those shares. In addition, no dividend or other form of distributions can be made in respect of them. Distribution means dividend. Company cannot pay dividend to themselves. They cannot take voting right by themselves. Companies Act prescribe that when treasury shares are sold or transferred for the purpose of any employee's share scheme, the company must deliver a return to the registrar not later than 28 days after the shares are disposed of. In some time, company pay their shares to the employees. Mean instead of giving them payment in form of cash, company make payment to employees in form of share. And if company making a payment in form of shares through treasury shares, they need to notify the registrar within 20 days of the share payment. Any consideration received, mean amount received on sale of treasury shares, is to be treated as profit for distribution purposes. That will be added to where retained earnings. That will not be put into separate cash. Under Companies Act 2006, in the event of shares are cancelled, there will be a reduction in capital, but there is no need for a special resolution of the members or authorization by the. This company can decide by themselves. Companies Act 2006 state that where treasury shares are cancelled, the company must deliver a return to the registrar not later than 28 days after the shares are cancelled. The return must state with respect to shares of each class cancelled, the number and nominal value of shares returned are cancelled, the date on which they were cancelled. You need to inform to the registrar within 28 days. How many shares, what is their nominal value, and the date. The notice must be accompanied by a statement of capital, which must state with respect of the company's share capital immediately following the cancellation. What are the total number of shares of the company after cancellation? The aggregate nominal value of those shares. For each class of shares prescribed particular of the rights attached to the shares, total number of shares that class, and aggregate nominal value of shares at that class could be ordinary or preference. The amount paid up and the amount unpaid on each shares, whether on account of the nominal value of shares by the way of premium. Treasury shares can also be created when a company initially issues the shares to the public, but keeps a portion of its treasury to be sold at a later date. When companies are selling treasury shares to general public, they need to notify. What is meant by distribution? Dividends. The company can only make a distribution, pay dividend out of profit available for that purpose, i.e. distributable profit. Whatever profit company is generating every year, that will be added to retained earning. From where company pay dividend? Retained earning. Company pay dividend from retained earning. Cash going out. What is debit? If you are paying dividend, what is the accounting entry? If you are paying cash, credit cash. What debit retained earning. That's why dividend is going to be paid from where? Accumulated profit. Accumulated profit is what? Retained earning, where all years of profit is going to be added. Is that fine? What is meant by distributable profit are the accumulated realized profit. Retained earning. Every year, profit will be added to retained earning, and that added profit of all the year is called accumulated profit. So far as not previously realized by distribution of capitalization, less the accumulated realized losses. Ultimately, if there is a loss, that will also be adjusted where? retained earning. So far as not previously written off in reduction in capital. Company can pay interim dividend as well during the year as well. It's on the company. Profit and loss, this can be from trading activities and capital transaction. In case of trading activities or capital transaction, company can pay from profit and loss account. Accumulated, what does mean by accumulated? Combined. Every year profit or loss combined balance is called accumulated. This looks at the cumulative profit or loss, not just the current year in isolation. For example, if a company made a trading loss of 1,000 in year one and 2,000 in year two, cumulative 3,000 loss, but a trading profit of 1,000 in year three, what is accumulated? 2,000 negative. It must make a profit in excess of 2,000 in year four before any dividend can be paid. If in year four, there is an other loss of, there is a profit of 1,500, still companies are having a 500 loss, there will be no dividend payment. If it is 2,500, yes, company is having 500 profit, now company will pay dividend to the ordinary shareholder. Preference you need to pay. In case of loss, you will not pay, but in case of profit year, you will pay cumulative with previous as well. What is it by realized? Against which you received any money. The profit coming from profit and loss account is a realized profit gain. There is another gain, revaluation gain, that is unrealized. And from unrealized, company never ever pay dividend. From where company pay dividend? Realized. Realized, a profit or loss is deemed to be realized. It is treated as realized in accordance with the generally accepted accounting principles. Provisions such as depreciation are deemed realized. If a general revaluation of all the fixed asset has taken place and result in a deficit, that deficit does not need to be treated as realized. Revaluation gain, revaluation loss is not realized gain or loss. Additional rule for public company. A public limited company can only declare a dividend if both before and after distribution its net assets are not less than the aggregate of its called up share capital and undistributable reserve. Undistributable reserve mean share premium, revaluation reserve. So a public limited company can only declare a dividend if both before and after distribution of dividend its net assets, what is meant by net assets? Total assets minus current liabilities, are not less than aggregate of its called up share capital and undistributable reserve. If their net assets are lesser than these two, company will not pay dividend. Mean your equity other than retained earnings should be equal to or more than net assets. If it is lesser, you will not be able to pay dividend. No. Their net assets are not less than, mean net assets should be greater than this. Undistributable reserve mean, what does undistributable reserve include? Share premium. capital redemption reserve, unrealized profit like revaluation reserve, and reserve that a company is forbidden to distribute, mean that company cannot distribute. The latest audited accounts are used to make the calculation, and these figures you need to calculate from the audited financial statements. What is the model article? That is defined by Companies Act. That is defined by Company Act. If companies are unable to define their article, then they will be following model article. So under the model article, the directors recommend the payment of a dividend under, and the company declares it by passing an ordinary resolution. The amount paid cannot exceed the amount recommended by the directors. Mean how much dividend company can pay, whether company is able to pay interim dividend, entitled to pay interim dividend or not. This will be included in articles. However, a shareholder is not entitled to a dividend as of right. This is not a right. Mean in case of profit, they will be having right on to receive dividend. Otherwise, they will not be having a right to receive dividend. Consequences of unlawful dividend. If company pay unlawful dividend, mean if net assets are not lesser than paid up share capital and undistributed reserve. If a dividend is not paid in accordance with the rules on distribution, then the company can recover distribution from shareholder who knew or had reasonable grounds to know the dividend was unlawful. They need to pay back the dividend. Any director, unless they can show they exercise reasonable care in relying on properly prepared accounts. The company can recover unlawful dividend from directors, but if they prove they paid the dividend on with reasonable care, then they will be exempted. The auditors, if the dividend was paid in reliance on erroneous, wrong accounts. If company paid dividend with wrong accounts, mean false financial statement, and auditor was aware of it, then any unlawful dividend will be recovered from the auditor as well. Because he knowingly approved a false financial statement on which dividend was paid. So from whom company can recover unlawful dividend? From shareholder, if they were known about unlawful dividend. From directors, if they unable to prove they took reasonable care. From auditor, if he signed erroneous accounts. However, if a director has to make good to the company an unlawful dividend, they may claim indemnity from the shareholder who, when they received the dividend, knew it was an unlawful dividend. If director proved shareholder were aware this dividend is unlawful, then director will not pay. Who will pay? Shareholder. They can recover from shareholder. Company can get money through loan, through debt as well. All companies have the implied power to borrow from the for the purpose of business. But that borrowing should be for the purpose of business only. Loan capital comprises all the longer term borrowings of the company, such as permanent overdraft from the bank, unsecured loan either from a bank or other party, or secured on asset either through fixed charge or floating charge, or by issuing debentures. What is a debenture? It's a piece of paper that company issue to any of the debt holder, not shareholder, debt holder. Could be company have issued to the bank for 5 years. Bank say, okay, I am giving you 100,000 against this piece of paper. I will charge interest, and after 5 years, I will hand back this paper to you and will receive my 100,000. This is similar like loan. But instead of issuing shares, company is issuing what? That document called debenture. What is debenture? A debenture is a document issued by a company containing an acknowledgement of its indebtedness, whether charged on the company's asset or not. Mean there could be some security of asset or could be without security. Normally they are on with the security, means secure debt. This paper is like a contract. I'm receiving this money, this will be the interest rate, this will be the time period. There are three main types of debenture. A single debenture, for example, a company obtain a secure loan or overdraft facility. Debentures issued as a series and usually registered mean issue more than one debentures. Debenture stock subscribed to by a large number of lenders mean company issue debenture to 10, 15 different banks. There are some advantages of debentures. The board does not need the authority of a general meeting to issue debentures. Mean they don't need approval from the shareholder through a meeting because their shareholding is not going to dilute. The debenture carry no votes. Debenture holder will not be having any voting rights. Interest is chargeable against profit before tax. Mean through this, by charging interest, company profit will reduce. Through reduced profit, company will pay less tax. Mean there will be tax saving. Debenture may be cheaper to service than shares. To issue shares, company need to bear more cost. Because to issue shares, first you need to advertise. There is expenditure of advertisement. You cannot sell share by yourself. You need to sell shares through brokers, and to brokers you need to pay the commission. That is also cost. And issue debenture, you don't need to bear any extra cost. That's why generating money through debt is cheaper than generating money through shares. Mean debt is cheaper source of finance than equity. There are no restriction on issuing debentures at a discount or on redemption. Might be company issuing debenture of 100,000 but receiving 90,000 but will repay back 100,000. But in share there is restriction. You cannot issue below nominal value. They are freely transferable. Even the debt holder can transfer that debenture to any other investor, and other investor will get money back from the company by showing the debenture. There are some disadvantages of debentures from investor point of view. Interest must be paid out of from company point of view. Company need to pay interest. Either company is having profit, either having loss. Irrespective of the profit of the company, if necessary, must be paid out of capital. Default may precipitate liquidator and on administration if the debenture are secured. Ultimately, if you are unable to pay the interest or amount, they can sell the security asset. And high gearing will affect the share price. Ultimately, if you are having more debt, your gearing will be high. Gearing means equity by debt by equity. Gearing means debt by equity. And more equity, company will become more risky. And if company is becoming more risky, nobody will buy your shares. And there will be no demand of shares. And this will reduce your share price. If you want to issue more shares, shareholder will say, okay, reduce your price because you are more risky. Because your gearing is high. Why your gearing is high? You're having more debt than equity.
Yes.
What is fixed and floating charge? Fixed charge against fixed asset, non-current asset. That is fixed. Fixed means you cannot sell, transfer that asset during the loan period. Floating charge against current assets like inventory. And this is not fixed, mean you can transfer, sell that inventory. So fixed charge is a legal or equitable mortgage on a specific asset, non-current asset. For example, land, machinery, motor vehicle, which prevents the company dealing with the asset without the consent of the mortgagee, mean who have provided you the amount, mean letter. Mean you cannot transfer, you cannot sell that asset. A fixed charge has three main characteristics. It is on the identified asset, mean a non-current asset. The asset is intended to be retained permanently, mean you cannot transfer or sell that asset. The company has no general freedom to deal with the asset. In certain circumstances, a fixed charge can be set aside by a liquidator or an administrator if it can be shown that the company sought to put a credit in a preferential position. This is covered more in Chapter 12. Mean in case of winding up, there come a person called liquidator who value and sell a company asset and pay off the debt. In that case, that asset can be transferred or sold, even in fixed charge. What is floating charge? You are getting loan by securing your current asset like inventory. In inventory, you can add, reduce, sell, transfer. So floating charge has three main characteristics. It is on class of assets. Not identifiable mean not current asset. Present and future. Present and future mean that will not fix. The asset within the class will changes from time to time. The company has freedom to deal with the charged asset in ordinary course of business. A floating charge cannot be created by partnership. Partnership can take loan on fixed charge. Only company can get debt either on fixed or floating charge. There is a concept called crystallization. What is crystallization? When a floating charge convert to fixed charge, that is called crystallization. Mean you took loan on your inventory, but the debt holder put a restriction. No, you cannot move, sell, transfer this inventory. This means it becoming what? Fixed charge. What is fixed charge? You cannot sell, transfer, or change the asset. So when a floating charge is going to be converted into fixed charge, that is called crystallization. So crystallization, floating charge does not attach to any particular asset until crystallization. In simple word, conversion of floating charge to fixed charge is called crystallization. Crystallization means the company can no longer deal freely with the asset. It occurs in the following cases at the time of liquidation. Obviously, you will not be able to sell your asset by yourself. Liquidator will sell and pay to the creditors. The company ceases to carry on business. Any event specified is unable to pay its debt. The company fails to look after its property. The company failed to keep a stock level sufficiently high. In while obtaining a loan on floating charge, you can change your inventory, but there was a restriction like up to this amount, you should always maintain inventory. And if you fail to maintain that inventory, this means that condition is breached. Mhm. So in that case, floating charge will convert into fixed charge. So there are three circumstances when floating charge will convert into fixed charge at the time of liquidation, when company is going to cease its operation, and when company breach the condition of maintaining a amount of inventory in floating charge. So that if you breach the condition, in that case, floating charge will convert into fixed crystallization. Advantages of floating charge. And if you are taking loan on floating charge rather than fixed, what could be the advantage? A company can deal freely with assets. Wider class of assets can be charged, meaning you can put your debtors even as a security. Not only inventory, you can put your debtors as a security. Debtors mean you are selling products to customer on credit basis. So they will remain there, but keep on changing. But there are disadvantages of floating charge. The value of the security is uncertain. It crystallizes from investor point of view, debt holder point of view. It has a lower priority in order of repayment than a fixed charge. Companies having a fixed charge of say 100,000. Then a company that is against say land. Then a company move to another fixed charge that is against say machinery. Then company move towards a floating charge. If suppose company becoming insolvent, who will receive their money first? This fixed charge first, then the second fixed charge, and then floating charge. If after selling company asset, only these two get their money and there is nothing left, floating charge will receive nothing. So from investor point of view, what's the disadvantage of floating charge? It has a lower priority in order of repayment than a fixed charge. It may be challenged by a liquidator if it was created within 12 months preceding a winding up. This is to prevent a company from giving preference to one of the unsecured creditors by giving a floating charge over its assets. I mean, if it was created within 12 months of winding up of the company, then liquidator might ask the floating charge to give up money if company assets are lesser than their debts. Similar concept like they will receive money securely first, and if there is nothing left, they will not be able to receive anything. Question understanding 7, please. Start. JIH Limited has borrowed money from K Bank PLC and has provided security by executing a fixed charge debenture in favor of the bank. There is a fixed charge. A fixed charge is a charge over specific company property asset that prevent the company from dealing freely with the property in ordinary course of business. Yes. A charge over a class of company asset. No, not class of company assets. On a class of company asset, floating charge. A charge over specific company property that enable the company to deal freely. No. A charge over company land enabling the company to deal freely. No. Which option? Why not option B? Due to this class of asset. Why not option B? Deal freely. Why not option D? Deal freely. Priority and registration of charge. I mean, which charge is having priority? The earliest fixed charge. Then next fixed charge. At the end, floating charge. So the priority of a charge depends upon the type of charge and whether or not it has been registered. Equal charges first created has a priority. Mean if there are more than one fixed charges, the first fixed charge will be having priority. Fixed charge has priority over floating charge. An unregistered registerable charges has no priority over our registered charges. Registered mean having some conditions. A charge holder, mean investor, can prohibit the creation of later charge with priority, but the prohibition is only effective if a subsequent charge has notice of the prohibition as well as the charge. Mean the investor can put a condition while giving loan to the company. You will not be able to get more loan. And if the second loan provider is aware of this restriction and he is giving loan, then the first loan provider will be having priority. On the winding up, he will be able to recover money. If there is no other left, the second loan provider will not be able to recover any money. So a charge holder, mean investor, can prohibit, restrict the company. The creation of later charge, mean you cannot get more loan against these assets with priority, but the prohibition is only effective if the subsequent charger has notice of the prohibition as well as the charge. And if he is aware there was condition from first debt holder, then ultimately first debt holder will be having priority. Registration. If companies are moving towards fixed or floating charge, they need to provide information to the registrar. So the company must also notify the registrar with 21 days of the creation of the charge. Registration can undertake by the company, by the charge holder as well. Failure to register, mean if within 21 days, company is unable to inform to the registrar or maintaining charge register, renders the charge void against the liquidator. Mean liquidator can consider the charge illegal because this was not registered. This means charge holder, investor, debt holder, he need to ensure whether company has informed the registrar. If company haven't informed, he should inform. Results in a fine on the company and every officer in default, and renders the money secured immediately repayable. The registrar can order the company to pay back the money immediately because you failed to inform the registrar within 21 days of the charge. If the charge relates to land, it must also be registered with the land registry as well, not only registrar of company, land registry as well. The company must also include all charges in its own register or charges. Obviously, company need to maintain charge register. However, failure to include the charge in the company's own register does not invalidate the charge. In that case, there could be fines, but that charge will remain safe. What is the difference between taking money through debt and taking money through equity means shares? Debt is a debenture, is a document issued by the company containing an acknowledgement of indebtedness. What is share? It is an interest of shareholder in a company. First, it create liability and then interest. Debt holder do not having voting rights while shareholder is having voting rights. Debt holder has a contractual right of to interest irrespective of the availability of profit. Whether company is incurring losses, they will receive interest. But shareholder will receive dividend in case of profit only. On liquidation, who will be paid before by selling company asset? Debt holder first and then shareholder. And debt holders require do not need to be maintained. Mean debt do not need to be maintained. They can be reducing. They can be keep changing. While share capital company need to maintain. Company cannot reduce share capital. In case of three ways they can reduce, and there is a process they need to follow: special resolution, inform, taking permission from the court, and then informing the registrar. Chapter finish. So chapter 1 to 8 we have completed. See you in next class with chapter 9.